When markets crash, your financial advisor will tell you, don't panic and stay the course. But they're not telling you the whole truth. Let's start with a simple truth that most advisors won't tell you. Market crashes are normal. They're not rare events. They're not anomalies. They're a regular, predictable part of investing. Since 1980, the market has dropped about 10% at least once a year. It's dropped more than 20% about once every 5 years, and yet through all of these drops, the overall trajectory has been upward. This is critical to understand. Market crashes aren't the exception, they're the rule. They are the price we pay for the extraordinary returns that stocks have delivered over time. Now here's where most investors go wrong. They treat market crashes as emergencies that require immediate attention, but the data tells us something completely different. Every single market crash has eventually recovered. Every single one. The question isn't if the market will recover. The question is whether you will still be invested when it does. Let me tell you about my client, Robert. Robert called me during the 2008 financial crisis. His portfolio was down 32%. He was terrified. He wanted to sell everything and move to cash. His exact words were, "I can't afford to lose anymore." What Robert didn't understand was that he hadn't actually lost anything yet. He had paper losses. They only become real losses if you sell while they're down. I asked Robert one simple question. Has your financial timeline changed? He was still 12 years from retirement. His income was secure. His goals hadn't changed. Only his emotions had changed. Fear had taken over his decision-making. And fear is the worst financial advisor you'll ever have. Here's what happens in your brain during a market crash. Your amygdala, the fear center of your brain, takes control. It triggers your fight or flight response. This was great for our ancestors avoiding predators, but it's terrible for making investment decisions. The rational thinking part of your brain gets bypassed. This is why panic selling feels so urgent and necessary in the moment. Your brain is literally telling you that your financial survival depends on you taking immediate action, but it's wrong. This brings me to the first strategy that's saved my clients millions. I call it the 48-hour rule. When you feel the urge to panic sell, wait 48 hours before taking any action. This isn't arbitrary. Research shows that the intensity of emotional responses peaks and then begins to subside after about 48 hours. During this cooling off period, don't check your portfolio. Don't watch financial news. Instead, review your investment strategy. You do have an investment strategy, right? If not, that's your first assignment after this video. Write down your investment philosophy, time horizon, and goals. This becomes your anchor during market turbulence. Let me show you what happened with Robert after implementing the 48-hour rule. After 48 hours, he was still concerned, but he was no longer in panic mode. We reviewed his long-term strategy, we looked at historical recovery patterns, and most importantly, we did not sell. Today, Robert's portfolio is up over 200% from that 2008 low point. Had he sold, he would have locked in a 32% loss and likely would have missed much of the recovery. Because the hardest part isn't selling, it's knowing when to get back in. Now let's talk about something that might sound controversial during a market crash. Market crashes create extraordinary wealth-building opportunities. Warren Buffett may have said it best, be fearful when others are greedy, and greedy when others are fearful. Think about it this way. When the markets are down, investments go on sale. It's the only store where customers run out when prices get slashed. If your favorite store had a 30% off sale, would you panic and avoid it? Or would you see it as an opportunity to buy what you wanted at a discount? This brings me to strategy number 2, strategic buying during downturns. I'm not talking about trying to catch a falling knife. I'm talking about systematic, disciplined buying when markets are undervalued. Let me tell you about my client, Sarah. During the 2020 COVID crash, markets fell over 30% in just a few weeks. While others were panic selling, Sarah and I implemented a strategic buying plan. We identified quality investments that were suddenly available at fire sale prices. We invested our capital in 3 different installments over the period of 6 weeks. The results were nothing short of remarkable. Those strategic purchases during the downturn are up over 70% now. This isn't about timing the exact bottom. No one can do that consistently. It's about recognizing that market crashes create generational buying opportunities. Some of the greatest fortunes in history were made by investing during market crashes. The key is having both the capital and the courage to act when others are paralyzed by fear. This brings me to strategy number 3, systematically rebalancing your portfolio. Most investors set their asset allocation and then forget about it. But market movements naturally change your allocation over time. Systematic rebalancing means regularly resetting to your target allocation. This forces you to do something remarkable. It forces you to sell high and buy low automatically. Let me show you how this works in practice. Let's say your target allocation is 70% stocks and 30% bonds. After a strong bull market, your allocation might drift to 80% stocks and 20% bonds. Rebalancing means selling some of those stocks to buy bonds to get you back to your 70-30% mix. Then when stocks crash, your allocation might shift to 60% stocks and 40% bonds. Rebalancing now means selling bonds and buying stocks when they're cheaper. This isn't market timing. It's a systematic, emotionless way to buy low and sell high. My client Michael has used this strategy through 3 market cycles. The cumulative effect has added about 1.2% annually to his returns. That might not sound like much, but on a $1 million portfolio over 20 years, that's an extra $600,000, all from a simple, systematic rebalancing strategy. Now let's talk about the strategy that prevents forced selling during market downturns. I call it the liquidity buffer strategy. The worst time to sell investments is when the markets are down, but many investors are forced to sell during crashes to generate cash for living expenses. The liquidity buffer prevents this scenario. Here's how it works. Keep a year or 2 of expected withdrawals in cash or very conservative investments. This gives your growth investments time to recover from a market downturn. My client Karen implemented this before the 2008 crash. When the market tanked, she didn't need to sell any of her growth investments. Her living expenses came from her liquidity buffer. This gave her portfolio time to recover completely, and she avoided the permanent damage of selling at market lows. The liquidity buffer isn't just about preventing disaster. It's about giving you the confidence to stay invested when the markets are volatile. Now I want to help you develop your own market crash action plan. This is a document you create before you need it. It outlines exactly what you'll do and won't do when markets are volatile. First, define your investment time horizon. Are you investing for 5 years, 10 years, 20 years, 30 years? Generations? The longer your time horizon, the more aggressive you can be during market downturns. Second, establish your rebalancing triggers. Will you rebalance on a schedule, like quarterly or annually? Or will you rebalance when allocations drift by a certain percentage? By the way, building and tending portfolios is what we do for our clients. If you'd like to work with us, our contact information and a scheduling link are in the description below this video. Third, determine your strategic buying parameters. What conditions would trigger additional investing when markets are down? How much money will you set aside for such opportunities? Fourth, create emotional circuit breakers. These are the steps you'll take when you feel panic rising. Remember the 48-hour rule? Document who you'll talk to before making major decisions. Write down the historical context you'll consider during volatility. Having this plan in place before market volatility strikes is crucial. It's like having a fire evacuation plan. You don't wait until your house is on fire to figure it out. You plan ahead when you're calm and thinking clearly. Everything we've discussed so far comes down to one fundamental shift: seeing market crashes not as disasters, but as opportunities. The investors who build significant wealth over time are not the ones who avoid volatility. They're the ones who understand how to use volatility to their advantage. Let me share something I've observed over my 30-year career. The clients who built the most wealth aren't necessarily the ones who earned the most. They're the ones who kept the right mindset during market extremes. They stayed rational when others panicked. They bought when others sold. They focused on decades, not days. This mindset isn't something you're born with. It comes from education and experience. Let's talk about specific actions you can take today to prepare you for the next market downturn. Because there will be another downturn. It's not a question of if, but when. First, create your investment policy statement. This documents your goals, time horizon, risk tolerance, and asset allocation. Build your liquidity buffer. Remember, this should cover 1 or 2 years of expected withdrawals. Third, set up your systematic rebalancing process, whether quarterly, annually, or based on allocation drift. Fourth, identify your trusted counsel. This could be a financial advisor, a knowledgeable friend, or a family member, someone who can help you keep perspective during volatility. Fifth, create a plan for how you'll be able to take advantage of additional investing during market downturns. This prepares you to act decisively when opportunities arise, and commit to ongoing financial education. The more you understand about market history and investment principles, the less likely you are to panic during downturns. The strategies I've shared with you in this video aren't rocket science. They don't require predicting the future. They don't require perfect timing. They just require understanding market history and human psychology. and having the discipline to follow your plan when emotions run high. Let me address something important. You might be wondering if you need professional guidance to implement these strategies. The honest answer is, it depends. Some investors have the knowledge, the discipline, and the emotional stability to navigate market volatility alone. Others benefit from having an experienced guide, someone who has navigated these waters before, someone who can provide perspective when emotions are running high. The value of good advice isn't just in portfolio construction. It's in behavioral coaching during market extremes. Studies by Vanguard suggest this behavioral coaching can add about 1.5% per year to your return. That's not because an advisor has a crystal ball, although I do have one, but it's out of order. It's because we provide the emotional discipline that many investors lack during volatility. Let me share with you one final perspective that's helped my clients enormously during market volatility. I call it the legacy perspective. Most investors think about market performance in terms of months or years, but true wealth is built across decades and generations. When you adopt a legacy perspective, short-term market fluctuations look very different. A 30% market crash this year means very little to someone who's going to use that money 30 years from now. In fact, if you're still in the accumulation phase of life, market crashes are a gift to your future self. They allow you to acquire investments at discounted prices that will compound for decades. This perspective doesn't eliminate the emotional impact of seeing your portfolio drop, but it does reframe it in a way that promotes rational decision-making. Ask yourself, how will you feel about this market downturn 20 years from now? The answer is almost always, I wish I had invested more when prices were low. This legacy perspective has helped my clients make some of their best investment decisions during periods of market uncertainty. It can do the same for you. I'm curious, what's your biggest fear when markets drop? Is it losing money, missing opportunities, or something else entirely? Let me know in the comments below. I hope the ideas I've shared in this video will help you to navigate the next market downturn with confidence and clarity. For more on investing and retirement planning, watch these videos next.